We're jumping straight into Sarepta Therapeutics today. Everyone is watching the price action, but the real story is the massive pivot into siRNA technology and the disconnect between the stock price and the revenue engine.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this massive 82% drop, do me a favor, subscribe and hit the like button. We are building a community of investors who want unbiased market breakdowns, without the fluff. So join us.
Okay, so let's set the stage. The stock is sitting around $17.79.
Which is a number that probably makes long-term holders wince.
Wince is putting it lightly. I mean, we are talking about a brutal 82% drop over the last year.
Yeah, if you just look at the chart, it looks like a complete disaster zone. But, and this is a really big but, the fundamental story underneath that chart is shifting. It feels like the market is pricing this as a single disease company that's, running out of steam. But the data is painting a very different picture of a broader genetic medicine platform.
And that's the disconnect we really need to explore. When you see a stock down that much, your first instinct is just to assume the business is broken.
Right, that the cash is gone or the science failed.
Exactly. But what's so fascinating here is that the revenue engine, the actual cash flow, is actually incredibly robust.
So let's start there. Let's start with the bull case. Because despite all the carnage in the share price, this company is printing money. They have this sort of boring but profitable side of the business that nobody seems to talk about.
Because everyone is obsessed with the flashy gene therapies.
Right. You're talking about the PMO portfolio.
The PMO portfolio.
And for the listeners who might not be biochemists, let's just break that down really simply. These are drugs like Vyondys 53 and Amondys 45. They aren't the new sexy science headlines that, promise to rewrite your DNA, but they are the workhorses of the company.
And workhorse is absolutely the right word. If you look at the preliminary revenue for 2025, Sarepta generated, $1.86 billion?
That is not a small number for a biotech.
No. In the PMO portfolio, the part you called boring brought in nearly $1 billion of that on its own. Specifically, $965.6 million.
Almost $1 billion from the old tech. And crucially, it's not shrinking, right? I mean, usually when we talk about legacy products, we expect a slow decline.
No, it's actually growing. In the fourth quarter alone, PMO sales hit $259.2 million. That was up 8% quarter over quarter.
So while the stock price is collapsing, the core business demand is actually accelerating.
That's the story.
This is what I find so interesting. They have this incredible moat around Duchenne muscular dystrophy, or DMD.
No, it's a massive moat. I mean, they hold about 80% of the U.S. market in this space.
80%, that's dominance.
It is. And you really have to understand the dynamics of this patient population to get why that number is so sticky. Duchenne is a devastating disease. It causes progressive muscle degeneration.
Yeah.
So once a patient is on a therapy that works, or at least slows that progression down, the switching costs are incredibly high.
Right. You don't just swap medications like you would with a generic allergy pill or something.
Exactly. Parents and doctors are, frankly, terrified of regression. If a child is stable on a Sarepta drug, they aren't going to risk a gap in treatment to try a competitor unless the data is just overwhelmingly better.
And has anyone else tried to come for them? I mean, the big players?
Oh, absolutely. The giants have tried. We've seen Pfizer, Roche. Yeah. They've all tried to crack this market.
Companies with virtually unlimited resources.
And they've struggled. They've faced safety issues or a lack of efficacy in their trials. So Sarepta has effectively locked it down because their proprietary tech just creates a huge barrier to entry.
Okay, so you have this cash cow that's protected by a very wide moat, but the market isn't rewarding them for it. The market is freaking out about the growth story. So let's talk about that, the blue sky potential. We have to talk about Elevidys.
Elevidys, the first gene therapy approved for DMD. It brought in roughly $898 million in 2025.
Which is huge. I mean, that effectively doubles their revenue stream compared to just the PMO drugs. But there's a lot of noise around it.
There is. But let's look at the efficacy first, because that's the foundation. The EMBARK Phase 3 trial. It showed sustained benefits over 3 years.
Okay, 3 years. That's the crucial context.
Right. This isn't a drug that works for a month and then just fades away. The data suggests it works long term.
Okay, so if the drug works and they are making money, why the pivot? Because the lead here is that they're moving into siRNA technology. Why shift gears if you dominate DMD with gene therapy?
Because they want to be more than just the Duchenne company. And frankly, gene therapy has limitations. It's incredibly expensive to manufacture, and generally you can only dose it once.
Because the body builds up immunity to the delivery vehicle,
The
right?
delivery vehicle, exactly. It's one shot on goal. This is where the partnership with Arrowhead Pharmaceuticals comes in. They're moving beyond just substituting a gene into silencing or manipulating RNA directly using siRNA.
Let's pause and really explain that because I think this is the aha moment for the technology. How is siRNA different from the gene therapy they're already doing?
Okay, think of it this way. Gene therapy, like Elevidys, is kind of like trying to tape a missing page back into a book. You're adding something that wasn't there to fix a function.
Got it.
siRNA is different. It's more like using whiteout. It is designed to silence specific genes that are causing problems. So if a gene is producing a toxic protein that is hurting the patient, siRNA just turns off the faucet.
So instead of adding a good gene, you're shutting down a bad one.
Precisely. And the key difference is that siRNA doesn't have that same one-and-done limitation. You can redose it. It's titratable. It opens up entirely new disease areas that traditional gene therapy could never really touch.
And this is where it gets really interesting for me. They aren't just tweaking existing drugs. They are going after whole new targets. What are we looking at here?
We're looking at targets like Huntington's disease, FSHD, and DM1.
And for those listening who aren't biologists, why do these matter? What's the big deal?
Well, because the market size for each of these is just massive. Take Huntington's disease, that's program SRP 1005. Right now, there is effectively no cure. It is a completely wide open field.
Wow.
And each of these programs, each one targets a market worth over $1 billion.
So 3 distinct billion-dollar opportunities.
Correct. And that changes the entire valuation model.
Yeah.
If they succeed in Huntington's, they aren't just a niche player anymore. They become a diversified genetic medicine leader. They aren't just the muscle guys.
And the best part, they aren't going to the bank to ask for a loan to do it.
Right. This is the beauty of that boring PMO business we talked about at the top. They are using their current cash flow to fund all this R&D. They aren't diluting shareholders to keep the lights on.
Can you explain why that matters so much? Because we hear about dilution all the time in biotech.
Sure. So usually a biotech company with a big new pipeline has to issue new stock to pay for the trials. That waters down the value of the shares you already own. It's like cutting a pizza into more slices. Your slice just gets smaller.
Right.
Sarepta is saying, we don't need to cut the pizza. We have the cash to bake a whole new one. They are reinvesting that cash to drive what they hope will be a huge reversal in their growth rate.
Okay, so on paper, this sounds amazing. Solid revenue, dominant market share, funded growth into huge new markets. But
The bear case.
the bear case. We have to address the elephant in the room. The stock is down 22% in the last 30 days alone. It's trading in the $17 range. Why does the market hate this stock right now?
In a word, uncertainty. Look, the market hates uncertainty more than it hates bad news. With bad news, you can model it. With uncertainty, you're flying blind.
And right now, there are some pretty big clouds hanging over the company.
Yeah, regarding safety, we have to talk about the safety scares. We do.
So in 2025, there were 2 patient deaths associated with the Elevidys treatment.
That's just tragic, and obviously, from a business perspective, it's terrifying for investors.
It is. It sparked immense safety scrutiny. When you are dealing with gene therapy, safety is paramount. The FDA has an incredibly low tolerance for risk here. And those deaths are a major, major reason the stock is slumped. It puts everything under a microscope.
And it impacts sales, right?
Yeah.
It's not just a PR issue. It actually hits the bottom line.
It absolutely does. Look at the fourth quarter. Elevidys sales came in at $110 million.
And what were they expecting?
The estimate was $121 million, so they missed.
Ouch.
Exactly. When you miss expectations and you have safety concerns, Wall Street punishes you. Hard. The fear is regulatory pushback.
What does that look like?
Well, the bear case is essentially that the FDA could tighten the label, restrict who can get the drug, or pause things entirely. If that happens, that growth engine we talked about, it just stalls out.
So the fear is that the blue sky turns into a storm. Precisely. And that feeds into what we call sentiment fragility.
Sentiment fragility. I like that term. It sounds like a psychological diagnosis for the market.
It basically is.
Yeah.
I mean, even though the pipeline looks good on paper, all those billion-dollar opportunities, the market is just incredibly nervous. The stock is acting oversold. The selling has been so aggressive, it's probably overdone.
But the momentum is weak.
The momentum is weak. It's like nobody wants to be the first one to step back in.
They don't want to catch a falling knife.
Exactly. The fear is that the turnaround might take longer than your patience can last. Investors are looking at that chart and thinking, do I really want to be the one to try?
Okay, so we have a battle here. On one side, massive revenue and a funded pipeline. On the other, these safety fears and a real lack of trust from the market. For the listener trying to figure this out, what breaks the stalemate? What should they be watching in, say, the next 30 days?
There are 3 specific triggers I'm watching very closely.
Okay, lay them on me. Trigger number 1.
The earnings date, February 25th, 2026.
That's right around the corner.
It is. They're reporting Q4 and full year 2025 results. Now, here is the key. Most people will just look at the EPS, the earnings per share. Do not do that.
Ignore the headline number. Why?
Because EPS can be noisy during a pivot like this. You need to dig into the 10K filing and look at the cash and debt figures.
Why specifically cash and debt?
Because of the whole pivot we discussed, you have to confirm that the liquidity is actually there to support the 2026 roadmap. If that cash pile is shrinking faster than expected, if their burn rate is too high, or if the debt looks unmanageable, that whole self-funded R&D thesis just falls apart.
Okay, so check the company's bank account, not just their income statement. Got it. What is trigger number 2?
Regulatory milestones. Coming up in February and March, we are waiting for an FDA meeting regarding full approval for Vyondys 53 and Amedisys 45.
These are the PMO drugs, right? The cash cow.
Correct. Currently, they have what's called accelerated approval, which is a conditional status. Full approval would lock them in permanently.
And why does that matter for the stock price today?
Because it removes a huge layer of risk. Analysts suggest positive news here could swing the stock significantly. We're talking potentially up to 25%. It validates the foundation of the company. It tells the market, yes, the regulators are still on our side.
That is a massive swing, 25% upside just on a regulatory stamp of approval. Okay, so earnings in late Feb, FDA meeting shortly after. What's the third trigger?
The science itself. We are looking at trial initiations and data in the first half of 2026.
This is the pipeline stuff, the news story.
Yes. In Q1 2026, we should see phase 1 and 2 data coming out for the FSHD and DM1 programs. And then in Q2, the start of the INSIGHT trial for Huntington's disease.
The Huntington's trial's big.
It's huge. If that data looks good, or even if the trial initiation just goes smoothly, it changes the entire narrative.
It shifts the story from troubled DMD company to diversified genetic medicine leader.
Exactly. And that narrative shift is what drives the multiple expansion. That's what makes the stock price really go up. It changes the label investors put on the folder.
So what does this all mean for the person listening right now? We've covered a lot of ground, from molecular biology to balance sheets.
It means we're at a pivotal moment. The company is in a transition period that is messy and scary and volatile. But the underlying mechanics of the business are generating nearly $2 billion a year.
That's the thing that keeps sticking in my head. $2 billion in revenue, and the stock is down 80%.
It's an extreme dislocation.
So let's wrap this up with a closing thought. The way I see it, this is an asymmetric risk-reward scenario.
Go on.
While the stock is trading near $17, the fair value estimates from analysts go much, much higher. It feels like the market has priced the stock as if the worst-case scenario has already happened.
Yeah.
As if the pipeline has failed and the FDA has already shut them down.
It is priced for failure, yes.
Yes.
The current price assumes almost zero credit for the future pipeline.
But if they're just okay, I mean, if the earnings are just stable and the FDA grants full approval for the old drugs, that $17 starts to look incredibly cheap.
That's the essence of the value play here. You're betting that the market's fear is exaggerated.
It's a battle between current fear, the safety scrutiny, the regulatory clouds, and future value, those billion-dollar opportunities in Huntington's and FSHD.
And that 82% drop we talked about at the start, that embeds a lot of that risk already. The pain has been felt by the people who held it last year. For a new entrant, the math is different.
Exactly. The upcoming data readouts in 2026 are just critical for anyone looking for that reversal. February 25th is the first test.
It certainly is. And it will tell us if the foundation is strong enough to build this new future on top of.
I want to leave you with one final thought to mull over. We talked a lot about the safety risks of gene therapy, but consider this. As technology improves, specifically with siRNA, the delivery mechanisms become safer and more targeted. If Sarepta proves that their new platform avoids the safety issues of the old generation, they aren't just diversifying, they're evolving into a fundamentally safer company, and the market has not priced that in at all.
That is a very distinct possibility. The technology curve is always moving, and usually it moves toward better safety profiles.
That's the lowdown. Thanks for hanging out with us on the Easy Money Show. Keep your eyes on the charts and your mind on the data. We'll catch you next time.